All right, good morning, everyone. Thanks for joining us on today's session of our monthly financial or market review, where we will be trying to, analyze the major happenings around the globe as it affects different economies, markets, and as well as it affects Nigeria. Specifically today, we'll be having some interesting conversations about how geopolitical tensions has impacted Nigeria, and also some points, right, across the Nigerian capital market, and how that also impacts our money, our investment, and also how we choose to invest going forward. My name is Samuel Oyekomi. I am joined here today with me, Abigail Kazima Adeshina. Good morning, Abigail.
Good morning, Samuel.
Yeah, thank you very much, and happy Easter to you. Happy Easter to every one of us, and welcome back to work. I would presume that those in Lagos are probably still going through traffic. Those in Abuja will probably be at work. Those in Port Harcourt, Kano, and other cities, apart from Lagos, would not be on traffic. We have a special guest with us today. Is the MD of Norrenberger Asset Management Limited, in person of Pabina Yinkere. He will be helping us to also analyze some of those conversations that we'll be having later on today. But without wasting much of our time, we'll go straight to the conversations, right? Just as we do here every month. We start with global economy, global view, and I think one of the most important things that anyone will be able to reference that has happened in the month of March would be the war between Israel, Iran, and the US, right? At the end of February, as everyone would also remember, Israel, together with the US, attacked Iran, and that has pretty much caused a disruption in the global economy and global market. First, what we saw happen was that crude oil prices skyrocketed significantly as a result of that attack. Of course, Iran is one of the major oil producers globally, but also Iran also decided to defend its own territory by affecting global market through hindering any form of movement through the Straits of Hormuz. And as you see from the chart above, right, you see the amount of vessels that passes through this Hormuz commercial hub, and you saw a significant decline at the beginning of March, and it has pretty much just remained at that level. And as a result of that, you could also see international crude oil prices surpassed the $100 per barrel mark. Also, on the back of that, we saw gold, which at some point had hit about 5,400 USD, right, also dropped below to the region of 4,544 thousand. But on the other hand, we had a reversing relationship with the DXY, which is the US dollar index, which had appreciated during that period, which again would suggest to you that as funds are moving away from the safe haven that we naturally know as gold, the funds are probably moving towards USD. But then a major question again, which we'll get to in a short while. In the month of February, we had a lot of macro data being released in the month of March for the month of February. And as you'd see, we saw inflation still cooling off across different regions. Of course, we believe that for the month of March, that there's going to be a major result of the surge in oil prices or energy prices across different regions in the world. So we saw US inflation numbers remain unchanged at 2.4% in the month of February 2026. For the US labor market, it shows some signs of cooling off as we saw that drop to 4.4%. Inflation in the United Kingdom also held steady at 3% in the month of February. And as a result of that, if you move to the African region, you also saw inflation slowed in Ghana to about 3.3%. In Nigeria, we saw inflation moderate to about 15.06% from 15.1%. In China, we saw consumer prices increasing by 1.3%, while in Eurozone, we saw inflation picked up slightly at 1.9% in the month of February. But as a result of the anticipation of high inflation, as a result of this surge in energy prices, we are now seeing central banks across the world now holding rates rather than the expectation of a cut at the beginning of the year. So you saw the ECB, US Fed, as well as some other central banks in Europe also holding interest rate as the outlook remains that inflation could be stoked as a result of surge in energy price. Again, in the US Fed have mentioned that their long run expectation for inflation is moderate, sustainable, and we saw how that also impacted treasuries in the US because of course they do not expect as much high inflation at the long run. Moving to the market, this is something that you call blood on the streets, right? Because the equities really suffered from the US, Iran, and Israel war, with quite a number of the indices that we track losing, right? The S&P 500 lost a little over 5% in the month of March. The Dow Jones Index lost also about 5%. The German DAX lost 10%. FTSE 100 also lost almost 7%, and so on and so forth. A keynote from there is to say that we had a whole lot of bleeding as a result of the war. Now, the anticipation of the expectation of how long this war is going to last will also pretty much also drive how the market is going to react. But I think if you look at foreign stocks during this period, you're going to find some stocks that are now relatively cheap, which are now good entry periods for anyone who seeks to go in there for a long term. We'll move to domestic market, and I have my colleague Abigail Kazim additional taking over from me.
Thank you, Samuel, for that succinct, rundown on the global economy as well as the global markets. That would actually, give a very solid background or a very solid foundation to what we're going to be, talking about in domestic economy. So moving on to, our economic dashboard for the domestic economy, you'd see that in the month of March, right, we had the inflation numbers, released, which, moderated slightly, to 15.06, right, from what we used to have, what we had in the month of January, 2026, right. We also had exchange rate, we also saw Nigerian's exchange rate, we also saw exchange rate as well. External reserves has also declined, and exchange rate as well. External reserve has declined from what we used to have in previous months in February, just slightly, just a little below, $50 billion. PMI is still significantly above the 50 points threshold, but this time around, declined to 53.2, point. We've had crude oil numbers. This crude oil number was as at the end of March, right? We are now at a different point as at Friday or even as at this morning, but as at 31st of March, crude oil numbers was at has grown or has broke, the $100 point, per barrel, as on the back of the geopolitical tension that someone already spoke about earlier. But however, despite all of these geopolitical tensions, we've also seen the equities market, both in NGX, right, and the NESD market cap, increasing and then growing stronger. Although a little slightly, although the growth is quite, just marginal, compared to what we've seen in the previous months, but we're still growing, compared to what the global equities is saying. And we'll discuss this further, when we start to chat and ask questions from our special guests on today's episode. NPR is still as it is. We're expecting the Monetary Policy Committee to meet in their next meeting in May, next month. They should meet next month, which would, decide the monetary policy way for Nigeria. We also had the oil production, numbers coming in about last week, which states that Nigerian oil production output is now also came in, lower than OPEC, lower than 1.5 budget, right, or benchmark, right, that was supposed to meet. We've not been meeting that for a while now, and money supply has also declined significantly. And other news, right, we've had the Senate increasing the budget for 2026, right, up by 9 trillion to about 68.3 trillion. Right. This was done, about last week, right? About half of that, just a little below half of that, right, is supposed to be pumped into capital expenditure. A quarter of that is supposed to be used for debt servicing, and another quarter, for recurrent expenditure. Also, revenue generation is supposed to be includes an addition of about 874 billion thereabouts from increased company income tax, right? Government is quite positive on the effect of the new tax reform, right? So we have that as well. Also, for the month of March, we saw back, doing their allocation for the month of February, right, hitting 1.889 trillion as well. The NGX also is set to adopt a T+1 settlement cycle effective from May 29, 2026. Right, this is on the back of what we had in the T+2 settlement, which commenced in November 2025, that we saw, which has also led to earlier settlement in the equities market, and prompting increased investors participation, led to encouragement in investor participation in the market, right? If we also had Nigerians trade surplus for Q4 2025 being released, right? Nigeria trade numbers are being released for Q4 2025. Even though this is a surplus, it's a decline from what we used to see, what we had in the previous quarter. Our capital inflow also came out for the same period at a little over $6 billion. Moving into the fixed income basis, you see, moving into the domestic market, for the fixed income in terms of short-term bonds or the treasury bill market, you see that we had the Q2 treasury bills in the calendar, coming up, which shows us that we have more issuances coming up for second quarter of 2026, than maturities that we're going to be expecting. This is in terms of just Nigerian treasury bills auctions only, right? And we're beginning to see, and as we've seen in recent times, with inflation at 15.06%, with MPR at 26.50%, we've also been seeing treasury bills, yields in treasury bill market, trend, lower or staying at a particular level, being benchmarked at particular levels. If you'd see, there's something interesting in the next slide in terms of long-term bonds, where we have expected maturities, beginning to see more maturities, particularly in the month of May. Right, in the month of May, we're expecting more maturities, especially in the OMO market. Right, we expect that to pumping more money into the market, and that will normally increase investors' demand for a higher yield. The question is now whether or not that the higher yield will come into play. The same story, that we have in the treasury bill yields, the same thing that we have for the FGM bond yield trend as well, trending lower compared to where we were, as at the beginning of the year. Similar thing, right, for the Eurobond yield curve for Eurobond yield market.
All right, thank you very much, Abigail, for that. I'll be speaking to the Nigerian equities market. Just like I mentioned when we started, the Nigerian equities market seems to have some form of freeway away from what the reds that we've seen across the global equities market. So the stock market had performed positively in the month of March, of course, extending its year to date gains. In the month of March, it did about 4.3%. Year to date, already seen it in the region of 26 to 27%. And that's quite good compared to what we've seen across other markets, the US markets, and other European and Asian stock markets. And we've seen quite a number of movers, right? So the likes of Airtel, Dangote Cement have supported the growth that we've seen in the stock market so far this year. We also did like a compilation of some of the companies that have, of course, declared dividends for the financial year 2025. And as you see, we had the likes of UCAP, whose qualification date, of course, is today. We have the likes of Afri Prudential, Bar Cement, Dangote Cement, NGX, NASCON, Championsbury, even up to the point of Lafarge, Seplat, Bradford's, and up until recently, GTCO also have declared dividend. I think GTCO's final dividend is something worth of note at 11.76 naira, right? That puts that dividend yield at 11.4. And as you see from that chart, it's the highest compared to others. But of course, it's also interesting how we now start comparing that to other financial services sectors, particularly commercial banks, and see how that compares when the likes of Zenith, First Bank, and others of course, declared their dividend, and we're able to do some more comparison. But I think that's really worthy of note. Moving away to our consolidated watch list, right? Of course, we still continue to track each of these companies, and as you'd see, a number of them have done quite well from a year-to-date standpoint. So the likes of Access, Bossman has done 83% so far this year. Fitsin has done 99%. We've seen some losses. The likes of Ella Lakes, we saw a pullback at some point in the month of February, so it had lost about 10%, and the likes of Champs also have lost about 3.8%. If you look at Nigerian breweries have lost 7%. Those are the only three stocks out of our portfolio that have seen losses so far this year. But aside from that, we've seen some impressive returns, which again, by the time we move to the next slide, you start seeing how that has also played across the entire portfolio. So for the month of March, we saw our NTSI, which is the Norrenberger Nigerian Corporate Sustainability Index, had done 27%. It moved slightly from the 26.32% that was quoted in the previous month. Our defense stock, which is a compilation of stocks that we believe are solid enough and can give you great appreciation over a long-term period. Of course, those are fundamentally sound stocks. I've done 32%, improved from 27% the previous month. Dividend yielding stocks, which are, of course, stocks that have the highest dividend yield in the market as of the end of this year, beginning of this year, of course, when we came up with this portfolio, I've done 37%. While our growth stock has now reduced, of course, we've seen a lot of pullbacks and profit taking in the month of March, which has impacted some of these stocks. You find the likes of Alex, the pullback in the likes of Alex to have affected this growth portfolio. But again, it's still strongly above the broad market. Growth stock has done 29.87, while the ASI has done 29.35. Of course, the ASI still models around the NGX30, which has gained about 28.78%. And the chart just gives you an indication of how much volatility we've seen across the portfolio compared to the broad market. Of course, what you see is that the upturn, right, the significant push came in at the beginning of February, and while in the month of March it was pretty much a stable movement, albeit some slight volatility across those periods. And at this point, we will now pull the curtain on the conversation concerning the analysis of what has happened in the market in the last month, as well as how they compare with the month of February. And then we'll have a proper conversation with our guest today. I don't know, Abigail, would you want to do the honors of introducing our guest?
Thank you, Samuel. Thank you. Yes, please. Today with us we have the honor of having with us the managing director of Norrenberger Asset Management. As you all know, Norrenberger is your one-stop shop for all your financial needs. And one of our subsidiaries, Norrenberger Asset Management, and we have here with us the Managing Director, Pabina Yinkere. Good morning, PB, and thank you for joining us.
Oh,
Hi, Pabina.
can you hear me?
Yes, I can hear you now.
Okay, great. So thank you for having me. Good morning, Sam. Good morning, Abigail. And good morning to all our guests. I look forward to a very interesting session today.
All right, thank you, PB. The subject, right, or the crux of today's conversation, right, besides the review of both domestic and equities happenings that we've already given, is to discuss the impact of this ongoing geopolitical tension in Nigeria or Nigerian investments, right? And this whole thing started late February, about 27th of February, thereabouts, where the geopolitical, where this crisis heightened, right? We've seen the Brent crude, going from as low as $77 per barrel, right, to over $100 per barrel. Precisely $109 per barrel as at Friday. And even as at Friday, something quite weird happened, right? Where the price of WTI, increased, gained more than the price of Brent, which does not happen every time, right? And we've seen that also impact the price of gold, which is now trading below $5,000 dollar per ounce, and other commodities like that. So how does all of this, global happenings, affect us in Nigeria? And also, I'm doing the presentation. We saw that Sam, while Sam was presenting global equities part, saw the S&P 500, the major indexes, right, all in reds, while Nigeria, whose NASD and NGX is standing strong in the gains, right? How is that playing out really for Nigeria?
Okay, thank you. Thank you for having me once again. I hope you can hear me loud and clear. Great. Yeah, so it's the war took everyone by surprise. We weren't expecting to see, this level of conflict and escalations happen when it comes to the issue, but it has happened, and how are we dealing with it? As far as it affects Nigeria, it's been, I would say, bittersweet. Sweet in the sense that as an oil producing country, higher oil prices generally is good for Nigeria, right? But on the flip side again, we are also beginning to see that it is also affecting the prices of energy. As you can see, the price of fuel has gone up since the war started. The prices of diesel has really gone up as well since the war started. You are seeing price increase in prices of gas and other, energy related products. So that's why I said bittersweet. Sweet from the sense that it's better for the government's purse, although we are not maximizing that to the fullest because our production is still capped and we are not, some of our production is still encumbered. But overall, better oil prices, good for the Nigerian economy, good for our reserves, good for our FX position. But on the flip side, higher energy prices would mean we have to deal with the possible fallout of inflation that may kick in from there, both domestic and imported inflation. Expected to take a little to trend upward because of what we are seeing in the markets today. But that's as far as it affects the Nigerian economy. But if we come down into the markets, like you have explained, we haven't seen that much of a reaction. And I think it's a combination of a couple of things. One, the expectation that oil or higher oil prices is better for Nigeria. And also, it could be, if you're looking at it from a global perspective, perhaps domestic investor influence is very strong in our market. What it means is that we have not seen as much selling as we have seen in foreign markets. Because if you recall, our domestic investors, be it our asset managers or our pension fund administrators, are the biggest investors in our market today, right? And for these firms, if you sell, where are you going to, right? What's the alternative? So there's really no incentive to have that big sell-off, as you have said. Maybe a little bit of sell-offs to rebalance portfolios, de-risk and things like that. But we haven't seen that big wave of sell-off like you have seen in some of the international markets. So I think Nigeria has held up quite well. Our equity market has held up quite well. Fixed income yields have ticked up a little bit, but not as much as one should have expected. So I think Nigeria has weathered this war. I think rather brilliantly, if you ask me.
Rightly said. Thank you, PB, for that response. Before I ask the next question, I'd like to say that you can ask your question or drop your questions either in the chat or in the Q&A session. Just below your device, you'll see a Q&A icon. You can use that to drop your questions, and we'll take them in the course of the webinar. Thank you, PB. Right, as you have said, really, we have more domestic investors in Nigeria. The latest report, right? Portfolio report that was released by NGX, states over 70%, domestic investors' involvement in the NGX. And we recently had, the NGX crossing its 200,000 or 20,000 mark, right, or threshold. So from your, vantage point as MD, and I know a number of investors, so I'm privileged to, talk to you directly. What are the what advice, right, or how would you interpret this happening to an investor? Say an investor approaches you, how would you interpret this to this investor, and what are the gains, or what should that investor look out for? How can the investor, benefit from this ongoing? That sounds a little selfish, but how can the investor benefit from this ongoing crisis?
Yeah, it's okay. I would respond to that question by saying what we have done as fund managers. So if you I'm sure in the minds of many people on our call today, there's a lot of volatility in the market, geopolitical tensions. How do I manage my investments? What is the way out? A lot of people may not know what to do in this time of crisis, right? I'd like to cast our mind back to 2020 when we had COVID-19. We were faced with similar market disruptions when COVID-19 hit. And I think if you look in our domestic market when we had the index case in Nigeria with the foreign gentleman that came in, we saw that markets began to sell off rather quickly, right? But of course, back then, one of the things I just told myself is that we've seen this happen before. We saw it happen with the Spanish flu in 1918 or thereabout. Markets recovered. COVID-19 came and happened. Markets recovered even stronger than where they were, after COVID. The same thing will happen this time again. I think market is just reacting to what is happening, but at some point in time, even if the war carries on for much longer than one would expect, the thinking is that market will come to the realization that this is the war. Away from the war, what are the fundamentals saying? Away from the war, what is the outlook on a couple of things? And to paint that outlook, what we should expect to see is that a fallout from this war should be that we should see globally inflation take up because of the impact on energy prices. And the natural reaction for central banks when that happens is to keep liquidity tight. So expect that there will be some measure of tightening or a less dovish stance. When I mean less dovish, a penchant not to reduce rates, right? Happen across central banks. I don't expect our Nigerian central bank to be any different from that. It needs to react to what is happening in the market as well. But I don't think we'd see anything too aggressive. I think for Nigeria, we would find a situation whereby we are not hiking rates, but we are not reducing rates as quickly as they should. Remember, we had hiked rates significantly coming into into this new government, we had hiked rates quite significantly. And today, the gap between where inflation is and where our monetary policy rate is still a very healthy gap, right? A very healthy spread. So it gives the central bank room to maneuver. Speaking to our equities, yes, we have seen resilience in the market, but I think now calls for the time for one to be very selective. You don't just go and buy anything out there in the market. You need to be selective. So you're asking yourself, which companies will be more hot from what is happening globally? Which ones are going to have gains from what is going globally, right? For example, your oil and gas companies are one of the most favored in the market today because of higher oil prices. So a portfolio rebalancing and a repositioning is what one should desire to do at this time, rather than just buy anything you like in the market. So for investors out there, I would say whenever you are faced with crisis like this, the first thing to do is do not panic. Seek advice, seek guidance, and know what actions to take. Most times I find that when people panic, they tend to lose more. Panicking could be, oh, once you see a crisis, you just start selling all your assets. And market do not always react that way sometimes. But for me, I think whenever there is a crisis, I'm not just, I don't want to say I look forward to crisis happening, right? But whenever crisis happening, for me, it just spells an opportunity to invest, an opportunity to buy things for cheap. So that's what I look out for. But of course, as a fund manager, how did we react to the outbreak of the war? The first thing we did was to de-risk our portfolios. What do I mean by de-risking? So from our bonds, what we are doing, we are selling bonds that are more sensitive to interest rate hikes, which are usually what we call high duration or long duration bonds that are sensitive to interest rate changes. We reduce our exposures there and come closer to the ones that do not react as much. So that's how we reacted in our bond portfolios. For our equity portfolios, what we did was to look at it and rebalance among sectors that we think are more exposed to any kind of global crisis happening. So overall take is that do not panic, seek advice, take strategic decision. But the most important thing, I'll repeat, the most important thing, be positioned to take advantage of better prices. So at this point in time, cash is king. You want to be more closer to cash in your investment so that you can take advantage of these opportunities that they come. That would be my advice for our investors.
Thank you, PB.
All right, thank you very much, Phoebe, for that. And I found the part where you spoke about crises and opportunities, and I absolutely agree with you. At every point in time during crisis, you tend to find opportunities. In fact, it takes me back to during COVID period. As of that time, the Nigerian equities market printed its best performance in the last 10 years or so during that period. I'm also saw that played around them in other markets. So of course, I absolutely agree. But I want us to, pedal back a bit. We spoke about how the federal government, or now the National Assembly, had pretty much passed in the budget for 2026, which again, I'd say is coming in late, but there's some interesting things. I know Abigail had mentioned things around how almost half of it is going to capital project, and a host of many other things. But I'm interested in two things, right? The assumption for our supplementary budget from last year was that crude oil prices were going to be around $64 a barrel. But now what we have is $75 per barrel. Now, again, for this same budget, the assumption around the exchange rate is around 1,500 to $1. Right now, we're somewhere around 1,380. And for an average person, right, because everyone seems to be skeptical around the strength of the Naira and what they should do to hedge against exchange rate volatility. Do you think that 1,500, like the government is giving us an indication of where Naira might eventually end up at the end of the year, or it is safe to say we are still going to remain around the region of 1,003 to 1,004? And again, $75 a barrel, considering the fact that Brent or even our Bonnie Light is somewhere around 110, 115. But the war sustains or it de-escalates. Is $75 a barrel, is it sustainable also from a fiscal point of view? Just help us look at those two-edged side of that conversation.
Okay, I'll start from the oil price bit. if you look at what has happened with the war in Iran, is that you've had some oil facilities being taken out. You've had issues around the infrastructure networks that deliver oil into the market from the Middle East. And if you recall, the Middle East, the Strait of Hormuz, where Iran is holding down, accounts for about 20% of global oil supply. And with the impact of the war and what has happened there, surely you would, I think you don't need a soothsayer to say that it will be, we might have, a little bit of delay before you see production ramp up. Even if the war ends today, you may still have months and months ahead before production ramps up or supply improves to the level that we had before the war happened. So what that tells you is that oil prices are likely to stay high. Whether it's over $100 or slightly below, I still think that disruption will keep oil prices up. So I think $75 per barrel is a very conservative position that the government has taken, if you ask me, given what we know today. It's a conservative position, so I think we should be fine in regards to that. Now, speaking to the second bit of sorry, can you remind me of the first? I think the first
exchange rate 1,500.
Okay, exchange rate. Yeah. So for exchange rates, there is a natural expectation that when you do a couple of things, exchange rates will be impacted. One, if you are reducing interest rates, what it means is that your local currency assets may not be as attractive as they used to be. So it may not bring in as much foreign portfolios, FDIs, as much as possible as it would have been if you had higher interest rates. So there's that expectation that interest rates should cool off, even as inflation cooled off in Nigeria. So the expectation to allow for some mild level of depreciation is not out of place, right? I think many of these assumptions were even put there before we saw this war break out, right? Now the war has broken out. The expectation is that we are likely to see a little bit of capital outflows, albeit not too much, because so far we haven't seen much. But I think a 1,500 is a prudent stance that the government has taken. Most times, what you find is that the government usually uses a weaker assumption for the exchange rate, right? When I mean weaker assumption, they like to give a headroom so that in the event you are missing out on your revenue objective in local currency, if you adjust your exchange rate, it can help you catch up in terms of revenue expectations as well. So 1,500 is not out of place. If you ask me, I think that's a good area where I think our currency should be ending this year. What that tells people in our market today is that this Naira strength we have seen this year, is a little bit shaky. I'll put it that way. We may not see that continued Naira strength. Not too much of a devaluation, but that continued strength may not be there. So for people betting against the dollar, I think maybe you need to reassess your portfolio. For me, I like to see it on the balance, right? I like to take a balanced position, have some exposure to Naira, have some exposure to dollar, so that you are well hedged. When things move in one side, you have some bits there. When it moves to the other side, you have some cover there. Rather than just moving all your assets to Naira or moving all your assets to dollar, you could be hot for any, movement in the exchange rate in any direction. So that's how I see it.
Yeah, thank you, PB, and that was quite extensive. I like how you were able to pick them across, right? Of course, the budget can help you to give you an indication of where the government is also seeing some of these indicators going to rest at the end of the day, which also helps investors to be able to position for some of those market opportunity. And I think one of the things I want to chime in, because you mentioned earlier, and I think we also mentioned the fact that the Nigerian equities market has somehow remained immune to what is happening in the global market.
Yeah.
And I just wanted you to chime in. What's the place of the recent reforms that we've seen in the last 3-4 years? I remember we released the Norrenberger economic outlook earlier this year, and we were saying that this is the year where Nigerians should expect to start enjoying the dividends of some of those reforms. Unfortunately, the Iran war now is here, and it's looking like that expected dividend is already looking very bleak, like it's not going to come anytime soon. But again, the fact that the Nigerian market remains quite resilient, because again, doing 29% and still during the war gaining almost 5%, where other markets across the globe are losing about 10-6%, still tells you that the market is looking quite good. And as much as we've seen a number of that gain also coming from the oil and gas component, we've seen quite very interesting gains also in terms of industrial goods, consumer goods, also the banking sector. Is there a place of the very numerous reforms that we've seen in the last few years in what is happening in the stock market?
Oh, yes, I think absolutely. In fact, if anything, I think some of these reforms has helped to double down on the market resilience. Some of these reforms include what we have seen with the currency. Liquidity has improved in the currency, driven, of course, we must give kudos to the central bank. It was the top call to stay the course, and what we can see, the benefits of that. The market is liquid. Cast your mind 2 years ago, you couldn't find dollars. Even if you had the naira and wanted to buy dollars, you couldn't find it. But today, we are not complaining about that because of the reforms that the central bank has done. Its return to orthodox monetary policy has helped to bring confidence into the market. So I think that is also playing a role in the markets as we see today. Other things to look at again is the government's reform when it comes to the fiscal side, taxes, and how that is helping to improve government's fiscal position. You also alluded, I think it was you, Abigail, alluded to the fact that 50% of our 2026 budget is channeled towards capital expenditure. Now, that is a good thing for every economy, because what it means is that we are investing in the country to bring growth for tomorrow, right? So I think these reforms have been good. And I also want to touch on the market reforms. The market reform being driven by the Securities and Exchange Commission, the market reforms being driven by the Central Bank of Nigeria, by PENCOM, with its increase in allocation to variable income investments. All of these things are coming together to give us a market that has a solid foundation, a market that is more robust, a market that is targeted towards driving liquidity. And I would also add the NGX as well, has also done well in driving transparency in our market, in improving transaction flows. We have T+2 trading. Very soon we are having settlement. Very soon we are having T+1 settlement. These things bring transparency to the market, it improves liquidity and builds confidence. So I think the reforms have played a very important role in what we have seen.
Yeah, thank you very much, Phoebe. And I like the fact that you ended that note with a number of reforms, even in the market, which, again, as you have mentioned, has also improved transparency and has also strengthened market sentiment, especially from the retail side. Because if you look at the NGX, for example, 90% is now being transacted by domestic players. And what is looking to me now is that we're already pushing out foreign players out of the market, which in my view, can eliminate volatility in the long run, especially when you see the likes of FPIs taking up based on whatever changes you see in the market. So I think that's quite good. And I also like the fact that you mentioned the SEC, because I was about to come there. Last year, the SEC came up with a new policy around mark to market. And one of the major questions that have come to my table in recent weeks has been, there's been a lot of volatility in my mutual fund. The rates just went up today and then went down tomorrow. And many people don't understand what has happened. And it is also quite important that we start, educating people as to some of these policies and the impact on their investment, so that when they see some of those changes, they don't panic. They understand the process and understand that, my money is not going into, my money is not being burnt. It's as a result of the fact that the SEC is taking us away from the amortized accounting structure into some form of real-time market, real price determination, right? So I just wanted you to help us, break it down to an average layman, what the SEC has done, how that is impacting funds going forward, and how investors should, so that they understand, all right, and what you as a fund manager, right, is doing to be able to, manage some of the risk that can also come as a result of that policy.
Okay, thanks, Samuel. I think this is a very important discourse we need to have today because it is going to define how markets are going to be going forward. So in September 2025, the Securities and Exchange Commission issued a circular to market participants regarding the management and the valuation of fixed income funds, right? So fixed income funds are your bond funds, really funds that invest in bonds and bonds, basically bonds, right? So the directive there was that fund managers should start adopting market pricing for their bonds. And let me explain this so that those of us there can be better educated. If I buy a bond today, bond most times here, you usually look at them in terms of the yield or the interest rate that is on that bond, right? But that bond also has a price. So it is the price at which you buy that bond that determines what interest rate or what yield you are getting, right? So if I buy a bond today, previously under the previous regime, if I buy a bond today and I am holding it to maturity, what it means is that if I buy a bond that is earning me 20% today, it will continue to earn me 20% for the life of that bond. Now, what has changed is that, remember I said this bond has a price, right? But in the market today, that bond trades every day and the prices change. The prices change because of the macroeconomic situation in the market, interest rates, inflation, those things determine the price of a bond. If interest rates go up, there's a likelihood that the price of that bond will come down because there's an inverse relationship between the interest rate or the yield on the bond and the price. When the price goes up, the yield comes down. When the price goes down, the yield goes up. That's how it works, right? So why is SEC introducing this new method? It is doing that for a couple of reasons. One of those reasons is that, one, it is seeking to drive further transparency in how fixed income funds are managed. Because today, if I buy a bond, I just hold it, nobody knows what's going on. By the time you have a situation where somebody is leaving the fund, he's not leaving that fund at where the valuation of that bond is today. He's leaving that fund based on when it was bought, right? So I think creating a situation whereby fund managers are able to benchmark their bonds or mark their bonds to market, as you call it, using market pricing on a daily basis. What it means is that it creates a fairer valuation of that bond and it treats everybody in that fund equally. Because if you were going to manage it in the old way where you buy and hold, at the point when someone is leaving and at the point when another person is leaving, they are not living at market price. So you're not being fair to those people and to the people that are still invested in the fund. But what this does for us is that it helps brings in a level playing field for everybody. Another thing it does, again, it brings transparency in valuation, right? Today, fund managers value their funds based on where they bought it. Sometimes it's a little murky determining what the true valuation of that fund or the asset they are holding in that fund is. But today, you can pretty much be ascertained that the prices are reflective of where market is and it's transparent. So I think this is a good introduction that the Securities and Exchange Commission has brought into the market. If you go to foreign markets, developed markets, that is how bonds are valued. That's how bonds are valued. That's how they are traded. They use the price. Nobody, use the yield as we used to before. I mean, we don't have all the time to explain this, but in a nutshell, this is what the SEC has introduced in the market. And they have given fund managers a 2-year transition window from that time. So it is expected that through 2026 and by half year of 2027, every fund manager should have marked to market or should fair value all their bonds. What is the implication of this on an investor? What it means is that, like I explained before, you will get transparency, you will get better pricing, you will get fairness and equity within the management of this fund, but it would introduce volatility in your bond valuation. What do I mean by volatility? Because these bonds are marked to market or valued, fair valued using market prices. Whenever the price goes up in the market, you will see the price of that bond go up. Whenever it comes down, it comes down. But I would like to say that this does not in any way make bond funds less attractive than they used to be. They will still continue to provide very good return for investors, very good diversification sources for investors. We just need to understand what is happening and how it is happening. And I'll give an example, right? We've seen the Iran war happen, and like we explained before, bond yields have gone up. Bond yields going up means prices have come down, right? This would have an impact on your portfolio because what it means is that when prices come down, the value of that portfolio will come down. In the reverse side, when prices go up, it means that the value of that fund goes up as well. The value of an individual's portfolio goes up as well. So you would have that volatility. But remember, these bonds are already earning you a coupon or an interest rate that is paid every half year. So that remains part of the bond portfolio, irrespective of the market price movements, right? You are only at a loss in that fund when the fund manager sells at the time when the fund has dropped. For the time that the fund manager is still holding on to that asset, even though the fund goes up or the prices of bonds go up or come down, what it means is that because they have not realized that loss, there is an opportunity to gain back what you have lost. So investors out there should not see a price dip or a volatility in their units, in the unit price or the valuation of their fund as a sign that the fund is losing value. No, that is not what is happening. It's the same way equities happen, right? Prices go up, prices come down. Although bonds are not as volatile as equities, but prices will go up and come down. So investors shouldn't see it as a loss. Rather, they should be more projected towards what is the expectation, what is going to happen, right? And like we have explained before, yes, bond prices have gone up during this time with the Iran war, but it also means that the opportunity or the upside for price gains to come from here on is also very high. Because what it means, if you are entering a fund today, you are buying it at a very cheap price from what it had been before. So I think that should be a focus. So investors should not be wary of what is happening in the market. It is the general cycle of market. It is what has come to be, right? And it's a general expectation. Every fund manager is supposed to maintain this. You don't want to say, oh, your fund is losing, I want to jump to another fund manager. You can't face the same situation or maybe even worse there. What you need to do is understand the strategy of the fund manager, understand how they are doing, understand how they are managing risk, and determining how you want to play it. And like for us, like I did mention before, one of the first things we did when this war hit, we de-risk. So we try to reduce our sensitivity to price changes. What do I mean by that? We sold bonds that, because the way bonds work is that if you have a bond that has a long maturity, it is more sensitive to price changes. So what we did was we reduced our bond tenors, reduced our bond exposures to the short end of the curve, meaning that if prices go up and down, we are not so much affected by that impact. So that is one way to deal with it. So we call it duration measurement or duration benchmarking in the market. So that's what we call it. I know many people will confuse duration for the length of the bond. Duration is not the tenor of the bond or the maturity of the bond. It is how sensitive the bond is to changes in price. That is what duration measures. And in today's market, when you are valuing bonds on a mark-to-market basis, what it means is that you need to watch your duration. When your duration is out of whack and bring losses to your portfolio. So for us, that's one of the things we are measuring when it comes to bond investing. Gone are the days where you just buy and hold. This time calls for real skill in understanding how bonds are valued. It comes with real skill in understanding how bonds are traded. And across our fixed income fund, our dollar fund, and our naira fund, we have tried to do this. So again, I think the key takeaway is that now is not the time to exit the fund, because if you exit now, you are losing the possibility of gains that will come tomorrow because prices are much low now. Maybe I'll just stop here and take some more questions.
Yeah, thank you very much, Ruby, for that. I think that was quite elaborate and clear enough, right? But of course, if we have anyone with questions, you can please send them through the Q&A session. I was going to come to the strategy part of it, but I saw that you already touched on that because it's also important that anyone who also wants to be able to choose a fund manager also understand that this reform and policy by the SEC is also a way to now start seeing how well fund managers can now perform. Because what you also find is that you have static or reactive fund managers or portfolio managers, but you also have proactive ones, right? Those who are able to see beyond just what is happening at that point in time. So it's also important that investors understand how the fund managers operate, the strategy behind their investment, their risk management, which again helps them to see how well they can do. Of course, when you have policies like these, beat global wars and all that, that's why it's also important that for an investor, you need to put your ears on the ground, listen to what your especially the research part of your investment houses are doing, because their calls also helps the investment side of things, which eventually impacts how your performance, your fund is going to look like at the end of the day. I know, Abigail, you might have some rounding up questions, so please can take them. We also have some questions in the Q&A, can also help us take them. Abigail.
Thank you. Thank you, Samuel, and thank you, PB, for those responses. Yes, we do have a few questions in the chat and in the Q&A session. This question is from Oluwumi. Yes, Oluwumi. I believe that you already answered this question, PB, but I think she wants an answer that is a bit more direct. So she said, I appreciate the ongoing discussion on panelists. Please, as a follow-up to the second question asked by Abigail, would you advise investors top up their investments based on the global tension and war between US, Israel, and Iran, which is affecting the whole world? She said she means top up our investments in Norrenberger mutual funds. Would you advise that she tops up our investment based on the ongoing global tension?
Oh, yes. I think now is the best time to invest. Like I always say, I don't pray for it, but when chaos happens for investment managers like us, it's a time for investing, right? It's a time to buy things cheap. So I think now is the best time you want to invest in these funds, because what you are doing now, you are coming in at a time when bond prices have come down and are much attractive. So now is not the time for exiting. Now is the time for doubling down and buying, because bonds are priced in the market. By the time we get, I track the news every day, and what is going on right now is that the US and Iran are negotiating to see how they can bring some kind of de-escalation of this war. Any news of that would send bond prices rallying. What I mean by rallying, bond prices will start rising, right? So you want to go in before that price rise happens. So now is a good time to invest in it. For our dollar fund, now is a good time to go into it. For our Naira funds, now is a good time to go into it so that you benefit from that price gains when they come.
Yeah, thank you very much, PB, for that. We have a question from Afinju Taiwo, and this is funny, right? But I understand the point, right? He said, PB, thanks for explanations on bonds, new regime, but you need to be more explicit. Please use figures like if I bought a bond at 1 million at 15% for 5 years, how does the new set market rules affect my interest? So before PB takes that, I need to maybe clear to Afinju Taiwo that this particular policy, right, or this rule is for fund managers, right? How it affects some things like mutual fund. So if an individual buys a bond at 15% for 5 years, of course, you continue to earn your coupon up until the point where you get your face value investment or your initial investment. So you are not at any point, you don't have to report fair market valuation or mark-to-market valuation to anyone. But of course, I'll also leave that to PB to chime in on that.
Oh yes, Sam, that's very correct. For an individual position, yes, you can do that. But for us as fund managers, that's the directive we have been given to value our funds. We have to mark them to market or fair value them. So let me break it down on numbers, right? So bonds usually trade in prices of 100. There's some complexity to that, but I'm not going to that. It trades in prices of 100, right? So for $1, a dollar-based fund now, it trades at $100. That is the par price, or the price at which the bond is issued for the first time, right? So if a bond issued at 15% is priced at 100 naira, for example, what it means is that when market activities happen, for example, inflation goes higher or interest rates move higher, what it means is that it has an implication on the valuation of that bond. And I'll give some further example. Let's say you buy a bond that's 100 naira at 15%, for example. Now, inflation now goes higher. You know why we talk about inflation? Sometimes it's difficult for people to connect inflation with market prices, but inflation, as they say, is and it erodes value, right? When inflation happens, it means that you are poorer. That's basically what it means. And it also means that the value of the assets that you own are less. So to compensate for that, interest rates would need to go higher to compensate for inflation that has gone up, right? The central bank will need to tighten monetary policy to cool inflation, and the different instruments that benchmark that central bank interest rate would have to go higher as a reflection of what has happened, right? So that's what happens. So I buy a bond at 100 naira, interest rates go up. What it means is that I told you there's an inverse relationship. What it means is that the price of that bond will come down, which means that bond might probably be at around 98 naira now, for example, instead of the 100 naira. What that means for an investor is that if I buy that bond at 98 naira, my return is not 15% anymore. As at that point when I'm buying that bond at 98, my return is more than 15%. Because 15% is when you are buying it at 100. When you're buying it at 98, you're buying it cheaper. So your return is more than 15%. I'd like to use a simple analogy. I have with me this pen, right? So this pen, let's say it costs 10 naira, for example, right? And I want to resell it, and I'm saying, or let me use a simple thing. Let's say this pen costs 10 naira, and the value I get from writing this pen, or maybe the contract, is 2 naira. So what it means is that 2 over 10 is what? 20%. That means I get a 20% return on this pen. If the prices drop, and let's say I want to resell this pen to somebody, and I'm strapped for cash, and I sell it at, say, 8 naira. What it means is that whoever is buying this pen is buying it at 8 naira, but he's still getting that 2 naira value of this pen. So the return of that person is now 2 over 8, which is what? 40%. You understand? So from earning 20%, buying it cheaper, you're earning 40%. So that is an example of how bonds work, really. Once you buy it cheaper, your return becomes better. So that is the whole thing we are trying to explain. And the same way it goes for the other side. If it goes more expensive, which means if the bond prices go higher and the rates come down, it means that the attraction for somebody that is investing in at that point at a premium is less. So it goes both ways. But as an investor, what you want to seek is try and buy when prices are low and sell when prices are high. That's how markets work.
Thank you for that detailed explanation, PB. I'm sure that he already has Olumi already has succinct idea on how that works, right? So Idris also has a question, right? This is basically on betting against the naira, right? It says that hello team, considering the fact that Nigeria FX market recorded $18.21 billion outflow and $11.61 billion inflow in Q1 2026, with the CBN absorbing $7 billion of the outflow in an effort to cap naira gain. Where do you see naira's best, worst, and where do you see the naira best, base, and worst case for the year?
Okay, I think we've touched on this a little bit before. For me, I think if you ask me, I think we've seen the strongest we've seen naira this year. I don't think we'll see naira appreciate anymore. the chances are that it will depreciate a little, not so much, but by a little. So for me, I think a 1,500, I would anchor with the government on that as well, is an ideal. Yeah, that would be my base case for where I think the currency should be. On a worst case, anything above a 1.5 for me becomes a worst case scenario for the currency. On the best case, the chances I'll put on that happening is maybe a 5%, right? My confidence level for that happening is a 5%. I don't see much of that happening. But if we see the naira hold on to where we are today, I would say that is the best case for me. So best case is where we are currently, 138 thereabout. Base case is closer to the 1.5 levels by the end of the year. And the worst case is way above the 1.5 that we are seeing. So in terms of confidence level, I'll put them at 5% on the bear case, which is Naira's paying where it is. I would put a 60% confidence level on the base case, which is around a 1.5, and a 40% on the bear case, which would be Naira crossing above the 1.5 threshold.
Alrighty, thank you. So that was from Idris. Idris Adini. Somebody also has a question about still on the geopolitical tension, right? As a question, said you spoke about reducing risk at the time of these geopolitical issues. Are there any plans you have in terms of hedging in foreign instruments?
Hedging in foreign instruments.
Yes.
Okay, there is always context to that, right? It depends on how you're looking. So I guess this person is looking at it from their own overall portfolio and investment. So from that perspective, what my advice always is do not swing wildly to any one side. Have a balanced portfolio based on your outlook. Have a balanced portfolio that gives you exposure to local currency, exposure to foreign currency. So that's how you hedge your investment, such that if you're seeing Naira weakness domestically, your investment in the dollar portfolio can be a hedge against that Naira weakness. And on the other flip side, if you're seeing dollar weakness, your investment in Naira acts as a hedge against that. So that's for an individual perspective. So I would advise gain exposure to dollar denominated assets, also invest in Naira, right? So have that balanced portfolio. From a portfolio manager perspective, how do I hedge? So I pretty much do the same thing. I have Naira exposures, I have dollar exposures, I have exposures across different asset classes, I have exposures across different geographies. For example, as an investor, I can invest in US denominated assets, I can invest in other currencies like euros and pounds, right? So investing in different currencies and investing in different geographies gives you the objective of risk management in investments, the cardinal, risk management principle, which is diversification. So having a diversified portfolio enables you to hedge against market movements across board.
Your diversified portfolio works every time. We also have another question from Oluwatimileyin, sorry. And I'd like someone to take that first, and then you give us, an higher view on that. So Timileyin says, seeing that we haven't really reached our oil production cap, like you said in our presentation, for exports, and raw crude oil is still being expensive for the refinery to purchase. Refined oil is still being purchased internationally by big oil marketers, which is giving expectation for high headline inflation, which can increase the cost of debt, which also affect bond prices. How does a Nigerian investor hedge against these bittersweet exposure?
Yeah, thank you very much, Abia. And quite a very multifaceted question, right, from Oluwatimileyin. So yes, of course, we mentioned earlier that our crude oil production is somewhere around the region of 1.36 million barrels, right? Our quota is 1.5, so we are not maximizing that. And even of that 1.3, right, a huge part of that is also encumbered in future contracts for some swap deals and whatnot. So we are not, of course, maximizing that. But on the tail end also, it also had inflation impact, right? I think every one of us can also see the impact, even from the normal things like petrol that used to cost somewhere around 800 to 900, now selling around the region of 1,350, 1,004, depending on where you're buying from. And then the implication is that as much as energy only accounts for about 10% of the inflation basket, it has ripple effect across board, right? Food that takes about 40%, of course, requires energy for transportation. You have things around transport in itself, health, education, and many other things, components in the inflation basket also relies on energy. So we think that we could see about 200 bips increase in our inflation, which we could take it to somewhere around 17%. The implication is that we do not think that the CBN is going to hike interest rates. We believe that they would just hold. The hold interest rate at that 26.5 region where we are. But of course, that also has implication for what bond prices would look like. And I think Pamela had mentioned earlier that what the fund managers management side of things have done is to take away those or de-risk away from some of those bonds that have sensitivity to interest rate movement. I think that's also something that an average person can also do. But looking at it from a retail investor who just has an array of assets to consider in terms of their investment position, right? You have equities, you have fixed income, you have mutual fund, you have also other alternatives. You also have foreign exchange exposures also. So you look at equities, right? The equities market has been good. But what we tell you is that for going forward, with the fact that we've done almost 30%, we're now seeing dividend being declared and whatnot, and that has had minimal impact generally in terms of how the market should shape up. It means that only fundamentally strong stocks would be viable going forward. So of course, you need to be quite selective when you pick on some of those your stock portfolios going forward into the year, right? The expectation is that the market is probably going to do somewhere around what we had done last year, which is about 50%, right? It has already done more than half of that, and we still have about 9 months to go. So you don't think that the market has that much upside. But of course, when Dangote Refinery comes into play, we think that is also going to drive a lot of conversation. And I also think that from the equity side, a number of IPOs for fundamentally good companies, right, that we are expecting at some point this year, I think they will come at very good entry position, which can give you very good price appreciation over the long term. So I think you could consider that from the equity side. For the bonds and treasury bills, I think you can as well just invest in all those risk-free instruments that are short term. So of course, as much as whatever changes will happen, you can easily convert to cash and of course take every other opportunity that you might find in the market. You might want to stay away from very highly volatile instruments like gold. I think gold is a good entry point, right? We could still see it hit 5,000 at some point, but of course, it is highly sensitive to whatever happens in the global market and also about the war. Nobody's in the mind of Donald Trump. So again, you should always try as much as possible to de-risk or reduce the exposures to things that are dependent on Donald Trump, because if you wake up tomorrow morning and decide that he wants the war to end, and then you find yourself being locked up somewhere. So of course, you need to find a balance, right? Any market that is highly volatile, try as much as possible to ensure that you don't have so much exposure to it. It's just to be able to ensure that at the end of the day, you have a very risk-adjusted return eventually. PB, please, you can chime in.
I think, Sam, you've answered it perfectly. The only thing I would just reemphasize this question is have a diversified portfolio. Right. I mean, sometimes it sounds like a cliche, yeah, diversified, but it actually works. What does diversification do for you? Yeah, is the concept of not putting all your eggs in one basket. I know there are some people that may have just been invested only in a money market fund, seeing the fund grow and are enjoying it. No, that's not. I hope you can hear me. Yeah. So that's not how you should approach investment. Have a diversified portfolio. Have some investment fixed income fund, have in dollar funds, have equity positions. If you can gain some commodity exposure, like Sam said, gold, also have that, right? So what you do is you create a portfolio that is resistant to shocks in the market. That's how we should invest.
Thank you, PB, and thank you, Sam, for those responses. I'm sure Timile already, gained insights right into how to go about this. Thank you for joining today's webinar. Thank you for joining today's webinar. For the past 4 months, we have been, while we present our slide, particularly during while we present the domestic equity part, we usually talk about our consolidated watch list, which usually the top on the list is always our Norrenberger NCSI, the Norrenberger Corporate Sustainability Index, right? And I'd like Sam to talk a bit about that and the exciting news that we have coming up.
Yeah, great. Thanks, Abigail. Right, just like Abigail mentioned earlier this year, we mentioned a couple of our portfolios. We mentioned a couple of our portfolios, and one of them is the Norrenberger Nigerian Corporate Sustainability Index, right? Which, of course, mirrors companies that have one of the highest corporate sustainability practices around things around ESG, environment, social, and governance. So for companies listed on the stock market. So in the last 1 year, we've been working on that index. And I'm happy to say that by the end of this month, on the 28th of April, 2026, we will be launching this report. This report is an extensive document, right? It's over 250 pages worth of documents that analyzes about 19 companies. We analyzed the entire market really, but at the end of the day, we picked about 50 of them, and of that 50 we analyzed, and then 19 of them were seen to have passed our own internal method of measuring some of these companies in terms of how they performed from an ESG point of view, and that report will be out by 28th of this month. I think it would be nice for you to just keep your fingers crossed. It's going to be quite insightful. One of the things that our report is also going to do is that it also help an average individual who wants to be able to pick companies in the stock market and say, oh, I want to invest in companies that are ESG compliant. It's easy to just take up that report and say, which one of these companies should I pick? And then you're able to invest in them. And also literature research over time have also shown that ESG compliant companies are profitable, both in the medium to the long end. We did a back test also in the stock market and saw that in the last 5 years, this set of companies have outperformed the market in the last 5 years. So imagine last year where the market did about 50%. If this index could outperform the market, it tells you that the backtest and the structure around the methodology is quite robust, and it's something that anyone should be able to bank on, given all things being equal. So, of course, keep your fingers crossed for the 28th of this month when this report will be out. We'll send it out to all our mailing list. We'll also have a launch, right? So of course you can go to our website to download when it's out. For those of us who are already clients of Norrenberger, of course you have your emails. I'm also going to send to you. When we send it to you, please read, send to other people, because we think it's also going to be quite important, even for foreign portfolio investors who also want to, buy into companies in Nigeria. We think that is also going to help drive IFRS S1 S2 implementation that the FRCN has been trying to push in over a couple of years up until 2030. We think that's also going to help improve on disclosure, transparency around ESG for companies. And up until then, we'll say keep your fingers crossed. Again, as Abigail said, thank you very much for joining us for this session. A very special thank you to Pabina Inkere for joining us out of a very tight schedule. I think it has been quite an insightful conversation. I think anyone who has the emoji or clapping should please just clap, and let's just celebrate him for joining us. Of course, he's an executive in a business. Of course, he doesn't have that much time, but having us the opportunity to speak for the last 1 hour 21 minutes has been quite insightful even for me. Thank you, our viewers who are able to join us. We hope to meet again in the month of March, where we analyze the markets, the economy, global and domestic, and also give some insight as to the outlook of what we expect going forward. Up until then, do have a wonderful week ahead. Bye-bye.